we are going to look at some pretty awesome total return stocks with huge ROEs. Hold on to your seatbelts, folks. This is going to be a good one. You may know that one of my favorite fundamentals is a little thing called return on equity, or just ROE for short. ROE is a financial ratio that measures the profitability of a company in relation to its equity, or in simple terms, the value of the shares held by, well, us, the shareholders. Now, according to our good old buddy Mr. Math, it is calculated as net income divided by shareholder equity. ROE is then expressed as a percentage. ROE effectively shows how efficiently a company uses the money invested by its shareholders to generate, well, profits. It's quite a valuable statistic for evaluating a stock because it provides insights into a company's ability to generate that profit without needing a whole bunch of additional capital. In most cases, a higher ROE indicates a financially efficient and potentially more profitable company, making it an attractive metric for investors looking to gauge the performance and investment quality of a company that you may be interested in. With that being said, it is important to consider ROE in conjunction with other financial ratios, as high ROE may sometimes result from high debt levels rather than effective management. We will see an example of this on one of the stocks in today's list. Join the conversation. Let us know in the comments if you are using ROE as one of your criteria for evaluating whether a stock belongs in your portfolio. Your participation is well appreciated. Don't forget, of course, to like and subscribe to stay up to date on future content, and a huge thank you for that click. For these stocks today, we are primarily focusing on return on equity, and they are ranked by that stat. In addition to ROE, we also wanted them to have at least a share price over $5 and a positive return profile on, well, the 3-year, the 1-year, and the year-to-date. So without any further ado, let's do this. Kicking off this list at number 5, we have Restaurant Brands International with a ticker of QSR, based out of Toronto. QSR is a massive restaurant company on a global scale. They own, well, huge names like Burger King, Tim Hortons, and Popeyes. Their current share price at time of recording is at $97.53. They have a market cap of $43.47 billion, and they've got a very average beta of 1.00. You can't get more average than that, folks. Their earnings per share comes in at 3.99, and they have a price to earnings ratio of 24.44. That return on equity comes in at a very nice looking 40.21%. Now, their debt to equity ratio is a little on the high side, 308.68%. That may very well be helping that ROE a little bit, but that's not the one I was talking about in the opening. Their dividend yield, it comes in at 3.101%. It is a quarterly dividend. It's paid out in 55 cents USD per share. Their payout ratio, very sustainable at 75.52%. Looking at their returns, on their 3-year return on investment, that comes in at 29.52%. We factor in those dividends, we get a total return of 38.09%. On the 1-year, not quite as impressive, 6.36%. Factoring in the dividends, we get a total return of 8.75%. And year to date, this year in 2023, they're sitting at 10.25%, and they have a total return after we add in the dividends of 12.73%. This is a company that holds some huge brands, and they should continue to thrive well into the future. Coming in at number 4, we have Computer Modeling Group with a ticker of CMG. Based out of Calgary, Alberta, CMG is a provider of reservoir simulation software for the oil and gas industry, with customers in, well, over 60 countries worldwide. That's quite a few. Their share price currently comes in at $10. They have a market cap of $809.33 million. Their beta, pretty average, maybe a little bit more at 1.14. Their earnings per share comes in at 0.30, and they have a price to earnings ratio of 33.33. That's a lot of threes. Their return on equity, that comes in at 46.60%. And their debt to equity ratio, that comes in at 64.85%. Dividend-wise, they have a yield of 2.00%. That is a quarterly dividend paid out 5 cents per share. Their payout ratio, once again sustainable, 66.67%. On their 3-year return on investment, we come in at 86.57%. Factoring in those dividends, we get a total return of 97.76%. That's not too shabby. On their 1-year return on investment, it gets even better, 102.43%. Factoring in them dividends, we get a total return of 106.48%. Can it get even better in the year-to-date 2023? Oh, yes, it can. Their return on investment comes in at 244.83%. Factoring in those dividends, we get a total return of 250%. Holy banana bread, that is pretty darn good. Whew. Oil and gas, maybe in a slight correction, but with the continued strength of the sector, this is a company who will be in high demand for, well, some time to come. Taking our third spot, we have Guardian Capital Group with a ticker of GCG. Based out of Toronto, they are a diversified financial services company offering services in, well, asset management and financial advisory. Their share price comes in at $39.75. They've got a market cap of $1.02 billion. Their beta, once again, very average, 1.06. Their earnings per share come in at 2.25, and they have a price to earnings ratio of 17.67. Their return on equity, that comes in at 54.30%. And their debt to equity ratio, not too bad, 14.20%. Looking at their dividends, they have a yield of 3.421%. That's a quarterly dividend paid out in the amount of 34 cents per share, and they've got a very sustainable payout ratio of 14.20%. On their return on investment for the 3-year, that return on investment comes in at 55.88%. Factoring in the dividends, we get 67.10%. On the 1-year, that return on investment, it comes in at 38.55%. Once we add in the dividends, we get a total return of 42.94%. And of course, on their year-to-date 2023, their return on investment, well, it's fallen quite a bit. It's only 2.58%. Total return after we add in the dividends of 5.83%. This is, though, a company that does look poised to navigate the current issues in that financial sector pretty darn well. In our almost top spot at number 2, we have Olympia Financial Group with a ticker of OLY. They are based out of Calgary, and they provide private health insurance and investment account services as well. They also handle currency and global payment solutions. Their current share price comes in at $89. They have a market cap, I think it's the smallest on the list today, $214.16 million. Very stable beta of 0.46. Their earnings per share come in at 9.48, and they have a price to earnings ratio, once again, pretty low, 9.39. Their return on equity, looking pretty good, 80.75%, especially when you see the fact that they've got very little debt with a debt to equity ratio of 14.08%. When it comes to dividend yield, these guys are the higher ones on the list today at 8.09%, and that is a monthly dividend in the amount of 60 cents per share. Their payout ratio comes in at 55.06%, so it's pretty darn sustainable. When it comes to returns on the 3-year return on investment, that comes in at a very nice 131.11%, factoring in their nice looking dividend, and that pumps it all the way up to 161.18% on the total return. Holy banana bread. On their 1-year return on investment, that comes in at 39.94%. Factoring in the dividends, we get a total return of 49.09%. And this year, year to date, we get a return on investment of 28.99%. Factor in the dividends, it brings our total return up to 36.52%. Once again, we have a great option in the financial sector, and they have a pretty nice dividend as well, so the passive income investors might like this one too. In our top spot at number 1, we have Dollarama with a ticker of DOL. They are based out of Montreal, and they're a huge name in the dollar store game. Their share price right now, almost $100. It comes in at 98.57. Their market cap comes in at $27.86 billion, and they've got a pretty stable beta of 0.63. Earnings per share comes in at 3.09. Their price to earnings ratio comes in at 31.90, and their return on equity comes in at a huge 436.42%. Now, hold those brakes, pull on the brakes a little bit there. This number does look fantastic. However, it is the one I was talking about. It is skewed a wee bit due to their high level of debt. And when I say high level of debt, we're talking a debt-to-equity ratio of 1,109.9%. That is a huge amount, but it is part of the expansion game. They have been expanding like crazy, preparing to, be the store of choice in a recession, because they are recession-proof and they're going to make a lot of money in the recession. Let's switch over to their dividend. Their yield comes in at a very low 0.287%. It's a quarterly dividend, 7.1 cents per share. And of course, the payout ratio, super sustainable at 8.16%. 4%. On the returns, on their 3-year return on investment, that comes in at 87.54%. Factoring in the dividends, it bumps it up a little bit to 88.83%. On their 1-year return on investment, 24.08%. Add in the dividends, we get a total return of 24.42%. On this year-to-date 2023, their return on investment comes in at 24.16%. Factoring in the dividends, we get a total return of 24.50%. Dollarama is a recession-proof stock, and they will continue to thrive. That debt, of course, yes, it's scary, but they are rapidly expanding in a time when they are poised to only do better and better. Thanks to the economy and people having less money to spend, that debt will come down on the other side of this for sure. These are some pretty good looking stocks, and with high return on equities, they have a very good chance of continuing to do well into 2024. Of course, past performance may not be proof of future performance, but it can often stack the odds of success a wee bit. As usual, if you are interested in any of these stocks today, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. I think I heard a duck. Keep the learning going, watch my video on Canada's telecom sector, or test YouTube's recommendation skills by checking out the video on the right. Your choice will decide the winner, and I will see you in the next video.